Hey there, Casey Dim here, TaxSaleAcademy.com with a quick tip for you today. Today's quick tip is don't rely on tax valuations. As you might know, every county has a tax assessor, a tax appraiser that goes out and values the real estate so they have a number to base the taxes off of for that specific piece of property. Some beginning investors take these numbers and they use them as the fair market value. You should never do that. The tax valuations are just that. They are values for tax purposes only. Now, in some areas, they might correlate a little bit to the fair market values, but again, don't rely on these numbers. Oftentimes, they are very, very far off, and they might even just be a percentage of the actual value of that property. You have to remember also that they're not detailed valuations. It is usually just a guy driving by in a car, checking a few boxes, saying yes, the value has or has not changed, then they tax you off of it. Now, one thing you can do is watch the trends on these values. So if the property goes from $100,000 to $112,000 and then drops all the way to zero, that should be a red flag that maybe that piece of property was demolished or burned down or something along those lines. So watch for trends, but do not use the tax valuations as the actual fair market values of the properties. Instead, you must learn how to properly value the real estate for yourself as a tax sale investor. Learn how to do comparable market analysis and all sorts of other stuff. And if you're looking for more information on how to do this, of course, we teach it inside the Tax Sale Academy. And you can access that training by going to TaxSaleAcademy.com and clicking on the join button. Have a wonderful day, folks. Take care. Bye-bye.